Joe Weisenthal, Business Insider, said the entirety of the lesson of Mitt Romney's career is a testament to how awesome it is to take on debt when debt is cheap, and how good it can be, and how much it can increase the value of the enterprise that takes on that debt. Here are effective tax rates for corporate investments financed with debt versus investments financed with equity. That's the equity financing. You have an effective tax rate around 37%. And debt financing, you get a tax subsidy of about 4%.
Wow.
So this is one of the big ways that private equity works when we talk about tax arbitrage, is you're moving things from one column of the accounting ledger to the other, from a place where they get taxed heavily to a place where you get a tax subsidy. I mean, in that respect, in terms of thinking about it as something making markets more efficient, it's constructed. It is an artifact of a set of policies about tax treatment. It would be like if you went to Indiana, bought a truck full of cigarettes, drove it to New York, and sold them. Exactly. You can make a neat profit because cigarettes are taxed much more in New York. You could undersell and reap the profit. But it's not like you're doing some amazing thing in the Adam Smith sense of market innovation. You're just taking advantage of
people selling cigarettes buying cigarettes in low-tax states and selling them in high-tax states was not the essence of what the financial crisis was about.
Right.
This was exactly square on a big part of why the economy collapsed in 2008.
Because of the incentives, the preferences to take on debt.
Exactly. Because every entity that could be was, levered up to the wazoo.
But the interesting thing that if you look at that diagram again, one of the interesting things about it is that when we usually think about capitalists, what capitalists do is take on risk, right?
Yep.
And so you put your equity at risk and you get a return. If you look at that, what you see is a circumstance where we subsidize people not to take on risk but to transfer risk, and they transfer it to the banks.
Right.
But since the banks are insured, they transfer it to us.
Right. And to make that equity component as small as possible, so that if the equity is some representation.
Explain what that means. What does that mean? Equity. What you're saying is that in the same way that. In the analog of a home mortgage.
So exactly. So a home mortgage.
5% down is
5% down. Well, why not make it 1%? Which is what we did on the home mortgage side.
Right.
But also here, buying a company, the principle is not that different. The structure, the incentive, if the equity represents your risk, the structure of the tax code encourages you to put as little risk in as possible and to transfer that out to whoever else.
And I should say, when we had the tax reform discussion, interestingly enough, people will identify on the right and the left. I mean, in its framework for tax reform, the Obama administration has identified the tax code's preferences for debt over equity as problematic, as something to address in tax reform. It's actually something conservatives talk a lot about, in terms of how it distorts the incentive. But I love this idea of Mitt Romney as someone who his whole life business career lessons were about the virtues of debt and about how you can exploit debt. And now he's running for the nomination at the time when he's running with the debt clock behind him, and debt has become this signifier in the minds of the populace. It's a very simple, concrete symbol and token of how we lost our way, right? Mm-hmm. And the private debt has been moved onto the public debt balance sheet as a way of dealing with the crisis, and now everyone wants to turn around and say government's got too much debt.
But we've created this culture, right? We've created this culture where we expect to do very little and get a high return, right? We've created a culture where we now invest in companies that I'm not even sure what they do, right? We're going to talk about Facebook later. It's like how do they make money is a larger question. As somebody who's been intimately involved in going out and getting venture capital, I'm amazed at what people put their money into, and you're like, $50 million for urban box office, really? How does that work?
Right.
And then when it implodes, we all sit around and, it's like, oh, well, we'll just write it off and go on to the next thing. And that's our culture. And I think we do have to address what is it that we want to stand for moving in the future. Is this how we want to be defined?
And this gets us back to your question, which is, what do we want capital markets, well-functioning capital markets, what should they be doing?
What I usually tell my students is that in a well-functioning capitalist economy, what the capital market does is price future income, right? You put money in a venture. If the venture works, it's going to make some profit. So you buy a share of stock because you want a piece of that future profit, right?
It's a claim on a future earnings stream.
It's a claim on a future earnings stream. You lend people some money because they're going to be guaranteed to pay you back in the future, right? That's what the capital market's supposed to do. And the prices of those assets are supposed to reflect guesses about what that future is, and that future's kind of murky, so you get everybody together and they compete, and you come up with an average consensus price. The system we've constructed, to come off your point and your point as well, the system we constructed makes asset prices meaningless. Okay? Because what we've just done is we've said, borrow as much money as you can, take as little risk as you can, right? And make sure that you put the risk on the suckers who can't afford to avoid it. That would be us, the taxpayers, and the people who therefore know the least about these things. So Mitt Romney ends up making an enormous amount of money, putting the risk on people who don't know anything about it.
Where is that?
Respond to that, though.
Where is
I mean, far be it, to question an economist on
people
how
question
well
us all the time.
how well markets are doing pricing assets. But in defense of Mitt Romney and private equity,
that's why you're here, Jim.
Yeah. Everything is voluntary. Now, granted, not people getting laid off, but he has to go out and borrow the money from someone. The private equity firm has to go out and borrow the money from. There's not a machine out there that he presses a button and says, "Oh, I'm going to put $500 million into this, so now you give me $9.5 billion in leverage." He has to make the case to someone. Now, there was a bubble in the 2000s in which it became extremely easy to borrow money. Money was cheap.
And we saw a ton of private equity.
People believed in this thing called the Great Moderation, which we were never going to have another crash again, and so on. But people did put up risk. People did lend to these entities voluntarily. It wasn't just like, we're just going to throw it off. Most of the companies that Bain Capital invested in probably, weren't the type that got big bailouts, during the collapse and so on. Banks is kind of a different story because they do have these seemingly...
They have a government guarantee,
basically explicit
backstops.
But for the most part, the people who took the losses on things were people who entered into them voluntarily.
I absolutely agree, but the voluntary nature of taking that loss is not the issue, is it? Isn't the issue that somebody like Mitt Romney comes along and he puts his own money at risk and he borrows a lot of money and he makes it work, right? The question about the nature, what the capital market is for, do we want the banks to lend money to these guys to do this, or do we want the banks to lend money to other people to do other things?
Right. And is it channeling is it channeling capital in the most
channeling scarce capital to the most efficient uses?
And that brings us to our next question about the Facebook IPO and whether it was rigged to screw retail investors. We'll talk about that when we come back.